If you have more than 3 million in super, part of your investment earnings can now effectively be taxed at 30% instead of the normal 15% super rate. And if your balance gets above $10 million, the headline rate on effective earnings can reach even 40%. But here is where this is gonna get interesting. You may have heard that Australia was going to start taxing unrealized gains inside super, meaning you could owe tax on an asset that went up in value even though you hadn't sold it. That caused massive backlash. And if you still think that's how Division 269 works, there's been an important change, because that version didn't survive. Welcome to Taxplained, explaining taxes so you can minimize your tax burden while you maximize your freedom. Division 96 is essentially Australia's way of reducing the tax concessions available to people with very large super balances. Normally, investment earnings inside super are generally taxed concessionally. But from 1st of July 2026, there's another layer once your super balance crosses certain thresholds. For the 2026-27 financial year, the first threshold is 3 million. Once you're above that level, an additional 15% tax can apply to the relevant portion of your super earnings. So you're looking at a headline concessional rate of up to 30% on affected earnings. Then there's now a second threshold, $10 million. Above that level, there's a further additional tax, producing a headline rate up to 40% on the affected earnings. And importantly, both thresholds are designated to be indexed over time. But here's the change that matters most. The government originally proposed calculating Division 296 in a way that could capture unrealized gains. Your property increases in value? Potential tax consequences. Your private company shares become more valuable? Potential tax consequences. Even if you didn't actually sell them. This was one of the most controversial parts of the proposal. It's not how the final 2026 system works, thank God. Division 96 moved to a realized earnings approach. Think interests, dividends, rental payments, and of course capital gains when assets are actually realized. That's a completely different conversation. Now, most Australians don't need to panic about this, and let's be real about that. The government's own estimate was that fewer than 0.5 of Australians would be affected in 2026 and 7. But if you are in that group, details matter. Imagine 3 people. Person 1 has 1.5 million in super. Division 296 isn't that problem. Person 2 has 4 million in balance. Now they're above that first 3 million threshold. That does not mean their entire 4 million suddenly gets taxed at 30%. The additional tax applies to the relevant earnings attributable under Division 296 calculation to the portion above the threshold. That's the important distinction to make. Then you have person 3 with 12 million in super. They are crossing both thresholds. Now we're dealing with one layer of additional tax above 3 million and another layer once we're above the $10 million balance. And the people who need to pay particularly attention aren't necessarily people sitting on giant piles of cash. It can be business owners, people with large self-managed super funds, people holding commercial property inside super, or for example investors who accumulated assets over decades and suddenly find themselves around one of these thresholds. So don't just ask, how much cash do I have in super? Ask instead, what's my total super balance? What does my fund actually own? And what earnings are those assets generating? Because that's where this becomes a planning question rather than just another tax headline. Here's the part I think is getting badly explained online. You still see articles, videos and posts saying Australia is taxing unrealized gains. That was a legitimate criticism of the earlier Division 296 proposal. But if you're making financial decisions today based on that version, you're working on outdated information. The 2026 legislation changed that mechanism. Thankfully, unrealized gains were removed. Thankfully. That's the good news, particularly for people holding illiquid assets inside an SMSF. Because imagine your fund owns commercial property. That property, for example, increases by $500,000 on paper. Under the controversial earlier model, that valuation increase was potentially part of the Division 296 problem, even though the property hadn't been sold, thankfully. Under the revised approach, we're looking at realized earnings instead and only. But don't make the opposite mistake and assume that means asset-heavy SMSFs can ignore division 296. Of course they can't. The property may still, for example, generate rent. Assets may eventually be sold. Private investments may produce dividends. And once realized earnings occur while your total super balance is above the relevant thresholds, division 296 can become very real. And there's another detail worth knowing. For the first year, so 2026-2027, whether your COTS is determined using your total super balance at 30 June 2027. And that creates a potentially important planning window for the next year. After that transitional year, the calculation changes, and simply pulling out money later may not produce the same result. So the real trap here is not they're secretly taxing your paper gains. The better question here is, are you about to cross 3 million without understanding what happens next, or the 10 million? So what should you do if you're approaching 3 million or already over it? First of all, don't restructure your super balance because of a headline. Moving assets can create another tax, investment, liquidity, and of course, potential retirement consequences. Instead, there are several numbers you want your accountant, tax advisor, or licensed financial advisor to model for you. Number 1, your projected total super balance at 30th June 2027. That date matters because of the transitional rules in the first year, as I told you before. Number 2, your expected realized earnings inside of super. Not just the value of the assets, what income and realized gains are they potentially producing? Number 3, what happens if assets stay inside of super versus being held elsewhere? Super can still be tax effective even when division 296 applies. A higher tax rate does not automatically mean get everything out. You need to compare the alternatives. Number 4, if you run an SMSF, look at the one-off transitional rules around existing assets. Certain small funds can elect for a division 296 cost-based adjustments using 30 June 2026 market values designed to prevent pre-implementation gains from being pulled into the new regime when those assets are eventually realized. That could be extremely important for long-held assets with large embedded gains. And finally, model the 10 million threshold separately, because once you're dealing with balances at that level, this isn't simply 30 million division 296, but higher, you're entering a different tax tier. The key is not finding a clever loophole here. It's understanding whether the assets you are currently holding inside super still make sense to hold there after the tax rules change. That's the conversation to have before you start moving anything at all. Remember the numbers. 3 million. That's where division 296 starts becoming relevant. 10 million. That's where the second tier comes in. And July 1st, 2026 is when the new regime began. But perhaps the most important takeaway is going to be this. If somebody tells you Australia has just introduced a tax on unrealized gains inside super, check the date on what you're reading or hearing, because that was the old proposal. The rules changed.